Well, Wednesday's inflation number finally brought Australia's economy back into some form of lockstep with other major Western nations. Though it was down just a touch to 3.8% in the year to June, it did open a window for the Reserve Bank to leave interest rates on hold rather than raise them, as had previously been thought. Well, the economy is still very weak, but the rate talk catapulted our stock market to record highs this week. And from this week coming, our largest companies start reporting their profit results. All eyes will be on the outlook statements as much as what's happened in the past year, as Steph Nash reports.
Tread with caution. That seems to be the expected message coming out of the upcoming reporting season. Valuations are high, with the ASX 200 index hovering at record levels. But so too, though, are the underlying pressures, like rising costs and increasing economic uncertainty.
I think it'll be cautiously optimistic. I think the pleasing thing that we see with across a lot of the companies that we look at is a lot of the supply side inflation really has started to cool.
But the caution is really built into 2025. So the companies will talk to still elevated costs, so inflation is still high. The wage growth is still at the high end for the businesses. At the same time, the freight cost has really gone through the roof. So now the impact on businesses will be dependent on whether they do import and export a lot of things. But that has gone up significantly, and we expect all the companies will build that into their expectations for 2025.
Listed investment company AFIC was one of the first to report this profit season. Its numbers were solid, reporting a 15% return for the 2024 financial year. Its CEO, Mark Freeman, is wary of heightened risks over the next 12 months, with concerns over lofty valuations.
We are cautious and we do look to buy when we see value, but we do stick with quality companies as well. So, I guess when we look at some of the longer term indicators, if you look at price to sales or price to book, or even the PE of the Australian market and indeed the US, valuations are certainly elevated. And we're a bit surprised that the markets have been so strong. They reacted very positively to the prospect of interest rates being cut in the US rather than looking behind the reasons of that, which perhaps more is about a slowing economy. So we're a bit wary. We're happy to stick with quality companies.
Plenty of shares are right now sitting at all-time highs. Aristocrat Leisure up over 30%. JB Hi-Fi and Wesfarmers up over 40%. Medibank up around 14% and REA Group up 25%. Joining them is CBA, which is up by almost 30% for the year. It's the most valuable company on the ASX, with its market cap hitting $230 billion. CBA's results are expected to be positive, in line with analyst expectations. But can it hold on to its elusive market status?
They should deliver a reasonable result, given most of the banks should deliver a reasonable result because of the provision they provided quite a while ago, a year and a half ago. And now they're just releasing a lot of those provision because the economy turned out to be a bit better than expected. To be quite frank, that's not real earning. I do think the valuation, though, that's the big challenge for the bank. CBA probably is the most expensive bank in the world. Whilst it's a great bank, invests a lot in its system, it's too expensive for this point of cycle. Economy is slowing down, cooling down slowly, and in that kind of environment, bank does struggle. So I do think this is probably the peak of the price you've seen.
Well, I mean, the first thing I'd say is CBA is just a wonderful business. It's a great business, but yes, it is trading on a huge valuation. I would say just generally, what I think will happen in the reporting season coming up is a lot of these successful businesses over the last couple of years, such as Commonwealth Bank, you might see some selling. Even though they have good results, you might see them become a funding source for other sectors that haven't been so good over the last couple of years, which have a better outlook.
Retailers are expected to be weathered coming out of the 2024 financial year. They're typically the hardest hit in an economic downturn. But after this week's better-than-expected CPI number and retail sales figures that were better than expected, some now wonder whether the outlook for retailers is not as bad as first feared.
I think we really have to split it in what's backward-looking and what's forward-looking. And 2024 was a year to forget for many retailers. It's been very weak, sluggish sales growth, and volumes are down and costs are up. So for 2024, for the past year, the numbers will look weak, we expect. But the real interesting bit will, how's the next year going to look like? And that's what the equity markets are going to look for. And we believe that we're going to see first signs of improvement.
It's quite interesting. Those companies, believe it or not, share price actually has performed incredibly well. For some names like JB Hi-Fi was trading at all-time highs now heading into the reporting season. I actually think the result will be pretty good. Even furniture doesn't look too bad, a little bit soft, but not too bad. Also, this is because they're cycling some very, very weak comp from the year before, so making it look better.
As soon as the June quarter inflation figure beat expectations, money markets changed their minds immediately and dismissed any suggestion of a rate hike next week. It's a good sign for retailers, especially given the expected flow-through of money from the Stage 3 tax cuts and cost of living relief in the budget.
So the one thing that we're looking for, and really the outlook that they generally give, is the first few weeks of trading in fiscal 2025. And that's what we're focusing on, and that's where we hope to see first indications that the tax cuts that came into effect on the 1st of July are actually inducing a response from the consumer. The consumers are willing to spend more, and we're seeing that sales growth picking up across all retailers.
I would say retail is probably one of the cheapest sectors that we look at. So we think there's a big opportunity in retail in the next few months. With the tax cuts that we've seen, and probably just a view that things are less bad. So retail features prominently in our portfolio right now.
And what of the miners? Recent downsizing and softness in commodity prices doesn't bode well for the performance of our mining companies.
BHP on the other side, materials sector, and that's what's been bringing down clients' portfolios. If you're overweight materials at the moment, you are underperforming the index.
So this reporting season, mining sector is going to be the big drag in terms of earnings decline for this year. So mining sector is looking at about 20% fall across the board in terms of earnings. Now, it's not because of it's not because they're not doing any worse. It's just really the commodity price has fallen quite meaningfully. For some of the bulks, such as the iron ore, is holding okay, but still fallen compared to the year ago. So I expect the big miners still deliver good earnings, but definitely lower than what it was, some 20% less.
As some of the miners head out of a boom cycle and into a bust, a fall in valuations could be a good opportunity to buy highly valued companies at a cheaper price.
Look, it doesn't bode well, but as we know in this sector, that things can change very quickly. But I think the most important thing at this juncture across a range of commodities is around their cost base and controlling unit costs of production. And certainly we've seen a lot of cost inflation in the sector over the last few years. So any moderation of that I think will be taken well, given, again, valuations have come down a lot. And also just making sure that a lot of commodities, particularly in the gold sector, can hold on to those aggressive sort of long-term production targets that they have.
In the US, Apple, Amazon, Microsoft, Tesla and Alphabet have all recorded their Q2 earnings right before our profit season kicks off. There's been a huge amount of volatility in US shares off the back of these results. Could that sensitivity filter through to the Australian market?
A lot of these companies have very high valuations. I think you just need to be nimble between sectors, work out which of those companies, potentially their valuations have gone up too much and need a breather. And that's certainly what we've seen in the United States over the last few months, such as Tesla and Microsoft. The actual results, particularly in Microsoft's case, they actually hit earnings expectations and have fallen considerably. So we think that will be a theme that we'll see through August.
What's happening in the US is that because the US interest rate is looking to be cut in September, now there's this big swing from selling the winners, which is tech company, and buying some of the cyclical, the losers, which is small cap, and some of the cyclical companies, which generally benefit when the rate does get cut. So you will continue to see that rotation.
So who are the winners expected to be this profit reporting season?
Yeah, we think G8 education, the childcare sector looks very interesting, very strong balance sheet, trading at 11 times price earnings, multiple valuation. Car leasing company SG Fleet, very similar, on around 8 times on a valuation, coming through a recovery phase. And we think those definitely look interesting. The retail sector looks interesting. The automotive sector looks interesting as well, which used to be one of the favourite sectors of the market.
I do think the bright spot will come from some of the healthcare companies. They have struggled for quite a few years for a number of reasons, whether it's labour cost or whether it's their operations being disrupted or whether it's the weight loss drug. We do think when the earnings starts, they have they will demonstrate their resilience in earnings and the improvement in a lot of their operations. So the likes of ResMed, the likes of CSL should deliver pretty strong result, and across the rest of the healthcare, such as your Pro Medicus and others. So it should demonstrate great result.